This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shahin.
Good day. This is Gabriel Shahin, certified financial planner and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. My job is to go over the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go on our Knowledge Center, which gives you a direct link to YouTube, where we've had well over 1 million views, multiple videos that help answer the questions that you have. And if you want to put an inquiry so we can talk about it on the show or create a Knowledge Center video, please send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And also you can go get this episode, any one of our previous episodes on Spotify, podcasts, you name it, folks. Now, I'm the president of Falcon Wealth Planning. We are a fee-only, non-commissioned, true fiduciary, folks. And we talk about all important topics of personal finance. That's where you are today, how retirement looks like, investments, estate planning, insurance, folks, you name it. Anything that involves a dollar sign, we can help you with. And we are offering 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost to help relate this show to your specific situation. And we have offices all across the country that we can help you with. Folks, give us a buzz. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, where we can help answer those questions that you have to help with your financial situation. Lots to talk about on today's show, folks. We are going to talk about interest rates. 'Tis the season here in September. Fed says they're going to lower interest rates. And I get it. Makes sense. It feels like it's been high for so long. Not only interest rates have been up, but you also have inflation that has been extremely high from 2020, 21, and it started slowing down in 22 and 23. But the point is we have seen rising costs from home prices going up, from interest rates going up, and with just total inflation going up. So how does this affect you? Because when you start looking at information like that, that is a key indicator and something in economics that's called monetary policy. And when our Fed say in September, we are going to start lowering interest rates, what that means for you is this impacts you in multiple different ways. It can be directly impacting you. Let's just say you have high debt, whether it's in credit cards, lines of credits, home equity lines of credit. These are situations that if they lower interest rates and your interest rate is variable, your payments are now going to drop. They're going to be cheaper. Now, that might not seem a big deal when you're at a 29.99% interest rate. Who really cares if it goes to 29.5%, right? I get it. But think about corporations that, oh, by the way, have billions of dollars on lines of credit. This is why interest rate helps the stock market. When they lower interest rates, now companies that are heavily leveraged actually have higher cash flow because their payments are less, which means higher profits. Stock markets go up when interest rates drop. Now, let's look at other situations that happen when interest rates drop. Let me give you a core simple one. Well, when somebody wants to buy a house and interest rates go down, they can afford more of a house. If the interest rate was at 7% and now it's at 6% mortgage, well, they maybe can afford more on their home. That might save them a few $100s a month out of their mortgage payment. So yes, it is important, very important. Now, what does this mean? Are more people now going to want to go buy homes? Man, we already have a supply issue in multiple states throughout the country. So yet again, these are things that need to be discussed. Now, it's not a bad thing, right? Everybody likes, for people who own homes, they like high prices. But what does this mean for a newer generation? Supply and demand. If more people now are wanting to buy, that is less supply, which means higher costs. So now, when we just thought real estate prices were kind of stabilizing and dropping, for all we know, there could be a surge, which could increase the prices of homes again. Yet again, these are some of the secondary effects that happen when interest rates go down. Now, here's another thing. When you look at banks, banks make money off your deposits. Okay. Now, what was happening is if you were to make $1 million deposit with any bank, they'll love you because banks can lend up to 4 to 10x of whatever you deposit. You deposit a million, that's $4 million to $10 million they can lend on your money. Man, if the average rate of return is 10%, holy smokes, they can make up to $1 million on your $1 million deposit annually. That's kind of crazy, right? But that's how they make money. That's why banks are very profitable investments, good investments. Ask Warren Buffett. He loves them. It's a majority of his holdings. So let's not digress, right? What does this mean, though, for you? Well, for you, you look at it from two angles. Angle number one, you may have a savings account at the bank. You used to be able to get 5% in the money market. Well, now that 5% is no longer 5%. It might be 4% and dropping. We know interest rates are coming down. Banks are doing this in anticipation of that. This is crucial. So another way banks make money, the other side of it is they lend more money. If they have a bunch of deposit, and when the interest rates are high, they now have money that they have to deploy, right? They can lend up to 10 times. They're not lending it out because nobody wants to borrow because it's 10, 15% rate on their personal loan or a 7, 8% on their mortgage. They're going to do something with the money. Well, you know what banks were doing is they were actually buying treasuries with their own money deposits. They could have $1 million deposit. They could buy up to $10 million. They can spend that money. They were spending it on treasuries, so they were making money on that. $10 million at 5% is no small amount. That's $500,000 a year of income off a $1 million deposit. You get what I'm saying? So the idea, of course, with this whole thing is banks actually are in a position of strength when interest rates go down. More people can lend. It's safer. They're collateralized for the most part. Now let's continue the conversation a little deeper. Remember those banks that went down in early 2023? Silicon Valley Bank, First Republic Bank. You know what they were doing? They weren't lending it to people. What they were actually doing is buying bonds. And the problem is when interest rates went up, well, think about it. They were buying bonds at 1.5%, 2%. Well, if interest rates on those same 10, 15, 20-year bonds are not 1.5%, but 3 or 4%, nobody's going to want those bonds, right? You're not going to pay what they paid for them because why would you want to buy theirs at 1.5% when I can get a new bond at 3 or 4? So they had to sell it at a discount. They paid $100,000 for a 10-year bond, paying 1.5%. They had to sell it maybe at $80,000, $60,000, a 20 to 40% drop on that bond. Because think about it. If a new one's at 1.5%, or their existing one was at 1.5%, a new one's at 3.5%, that's 2% a year they lose. At 10 years, that's a 20% drop. They lose out on 20% of the value. So this was some of the issues that we saw during that time. And this is some of the problem that we consistently see. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. And today we're just talking about the basic concept of economics, of finance, and some of the problems that we're seeing right now, just in general with lower interest rates. But there are more pros than cons. For example, if you have a globally diversified portfolio, if you have stocks and bonds in your portfolio, I talked earlier about stocks actually doing well when interest rates go down. They do better because a lot of these companies have debt and now their prices to service the debt is actually lower, which makes them more profitable. Simple as that. And again, all conversations of monetary policy. It's funny because the government actually controls, this is what people don't know, inflation and deflationary periods. Not complicated, folks. This is a great example of that. They're trying to slow inflation, hence why they're reducing the interest rates, trying to make things more affordable. Now, let's look at the bonds side. Very similar to the example with the bank. With the bank, if the interest rates go down and they locked their prices at 3% and now it's only 1, well, now they made money even more because everybody's going to want their old 3% one. So now I'm reverse engineering it to today. It's the same thing with you. If you bought bonds today, intermediate or long-term bonds, and interest rates are dropping, the prices of your bond portfolio, forget the yield, the interest rate, the coupon that you're getting, the principal value goes up because everybody wants your bond. It's pretty impressive, actually. This is why it's important to have a globally diversified portfolio because you're able to capture both sides of the spectrum. You're able to see how the portfolio moves when interest rates move on the stock and equity side. The crazy part is the stock market is smarter than everybody. It truly is. It thinks in advance. So if it only drops 0.25% and the market was expecting a 0.5% drop, the market will drop because it didn't drop as much. They were thinking it was going to be even more of a lower rate. Now, I'm not the only person that knows the Feds are going to lower rates coming up. The prices of the bonds already adjusted. That's why you saw a 4.5% treasury, in May, June, July, and then come August, September, you're seeing under 4%, 3.6, 7, 8%. So because you're seeing it in the threes, why are you seeing it now? Because the Fed said they were going to lower rates. That's why the treasury has been dropping already. It's always in anticipation. Everything is dynamic. Every comment the Feds say or anything that happens has a ripple effect in the future. And they call that the stock market. They're always 6 months in advance, and the bond market is no different. The question I always consistently ask is, what are you doing to be proactive about the changes that are happening? For somebody were you happy with 5% in your savings account? Well, now you got some people that put their money in treasuries or put their money in intermediate term bonds that were earning 4, 5, 6% that just saw a 2 to 3% appreciation within a 3-month period. That could be an annualized return of 8% on top of a 4, 5, 6, 7% yield. You get what I'm saying? There's more to it than just, I'm going to put my money in a target date 2040 fund. This is where you consistently have to analyze what are you doing and how can you improve your strength, your position of strength, and to make sure your portfolio is in a situation that is good long-term. You can't just buy and hold. I do believe in great long-term investing, staying disciplined, but to buy a position and hold on to it for life is crazy and foolish, especially with all these economic changes that are happening. This is why we're offering a free financial assessment where we're offering 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost. Give us a call. We'd love to relate this show to your specific situation. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short. Now, how I've been talking about right now is monetary policy. Okay, there's a whole other world to this, of fiscal policy. Monetary policy is changing kind of interest rates and so on, of how it affects the economy. The second piece of this is talking about fiscal policy. That's even more exciting. We're going to talk about this and the impact it has on your portfolio and the things that you need to be on the lookout when you're making long-term investment decisions and staying disciplined, because there's always a short-term reaction. But we're not looking for a reaction. We're looking to be proactive in your portfolio. And when we come back, I'm going to discuss ways that you can do that with first understanding what fiscal policy is and how important it is in your portfolio. We'll be right back after a few words.
This is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. We wanted to offer you a free financial assessment for listening to the show so you can help relate it to your specific situation. We offer multiple services such as retirement planning, where you are today, how retirement looks like, talking about Social Security, real estate, planning, even if you own a business, talking about taxes, not just how to save money today, but also throughout retirement. Talk about investments, making sure you're avoiding those high fees, costs, commissions, and also estate planning and insurance, just making sure you're properly protected if, God forbid, something were to happen. And we're offering 1 to 2 meetings, 1 to 2 hours of our time at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, and fill out the form fill right there on our site. We would love to help you in your financial situation. We look forward to serving you.
Welcome back, folks. This is Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth. Here on every weekend, we're talking about all important topics of personal finance, and 'tis the season of lowering interest rates. Everybody's excited. It's been long awaited. It's been how long? 3+ years since this has happened. So, what does this mean for you? Well, we talked about the monetary policy piece of it and how that affects institutions, how it affects companies, and how it affects you, and all these big pieces that come into play on how it affects your portfolio. So we get it. It's positive. It's good. We like lower interest rates. In hindsight, wouldn't you have rather not paid off your mortgage and had taken out a full value of your home if that was allowed? Let's say 80% value of your home at a 2.5% rate. Wouldn't you have done that in hindsight? And then, oh, by the way, put in a 5% treasury? I mean, think about that for a second. Look about how foolish and how naive and how greedy we were. Not happy to pay 2.5%? Hell, throughout that whole time, the stock market was earning 10+%. But no, you're conservative, right? How about forget conservative or aggressive? How about you be smart? You know what money can do for you. You're invested already. Why are you invested? Because you know it does and has the highest expected rate of return at a 10+%. Now, there's no guarantee to that. Heck, in 2022, the market dropped 20+%. In 2020, the market dropped almost 40% during COVID. We saw what happened in 2008. There is no guarantees, but if you're a long-term investor and you understand that, then why wouldn't you? The mortgage is 30 years long. What do you think is going to do better in investing? Putting your money and paying off a 30-year mortgage at 2.5% or having it grow in the stock market? What do you think is going to do better? Do you think the stock market can earn more than 2.5% over 30 years? I swear you better have said yeah, because if you did not say yeah, you do not know investing. So because we know that, why aren't we being better? Why aren't we being more disciplined? Why aren't we just being smarter about it? The problem is not you. The problem is you're not a professional, and you never will be. And even if you are you the smartest and greatest mind of all time? I'm a professional. I'm really good. I've been rated by almost every news organization as one of the top in the industry, and we're blessed for it. We're one of the fastest growing. Why? Because people sit with us and realize we know way more than them. Heck, we got ex-professionals that in the industry that have hired us. So yes, we are in the most humble way, well above average. And on top of that, one of the top in the industry. But that's not the point. The point is you have to make decisions today where it's not just buying and selling, but it's making reallocations to your portfolio to make sure you're taking advantage fully of every news information that comes out. Because anything that comes out today, there is a ripple effect for the future. And I talked earlier about the monetary policy piece of it, and we know interest rates are going down, but you did nothing. Hey, how about this? We knew interest rates were going up in 2022 at an aggressive period. And what did you do? You just held on to your bonds? Like, my God, were you buying still bonds just because you were adding money to your 401k or contributing to your investment account? Like, what are you doing? It's almost like catching a fallen knife. That could hurt. But, who am I to say anything, right? You're an amateur, right? It's expensive to hire a professional. Or you can try doing it yourself as an amateur. That's what really gets expensive. I'm not trying to do this to humble or humiliate or whatever you. I'm trying to teach you. Don't make the same mistake. By doing the same thing over and over again and expecting a different result is insanity. And people do it over and over again. They like to set it and forget it. Or maybe you have somebody that's a professional helping you, but all they're doing is selling you junk and product. Are you having high-level conversations? Are they reviewing your taxes? Are they going into in-depth detail of your investment and comparing it into certain indices? Are you over or underperforming it? If you're in active management, well, you better be overperforming. And guess what? Most people can't, which is why I believe and we practice, if nobody can beat the markets on a consistent basis, then how about you just join the markets? And this is why we consistently advocate to talk to professionals, get second opinions. And we do that all the time. We average about 300 first meetings a month of talking to people like yourself where we're able to give you that second opinion. How about you be one of those 300? And we serve all across the country, folks. It doesn't matter where you are. We'll give you 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's Falcon, WP.com for short. Would love to customize this conversation to your specific situation to see how you're invested. Because remember, we're just talking about monetary policy. There's another fiscal policy piece to this whole thing too. And that is when the government gets involved and tries to affect the cash flow of you or the companies you're investing in. And the biggest piece I like looking at is corporate tax. It's a fantastic example of that. During the Trump tax cuts in 2017 that implemented in 2018, where the corporate tax went from 35% to 21%, there's a reason the stock market went up, because just like that, companies had higher profits. With higher profits, what do you think that does to the stock market? Now, those are permanent cuts, unlike the personal tax cuts that go away in 2025. Did you know that, by the way? Did any professional you're talking to, whether your accountant or your investment advisor, have they told you that come 2026 your taxes go up? Like everybody's? I mean, and if the answer is no, because you do it yourself on TurboTax or you manage your own money, it's like, then what are you doing? Like, yet again, it's pretty expensive to be an amateur if you don't know these things that are happening in the future. There are strategies that you should be doing today to take advantage of that. I get frustrated thinking about it. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here on every weekend. And we are talking about all important topics of personal finance. And today we're just talking about the basic concepts of money. Interest rates are coming down here. The feds are saying it. Everybody knows it. It's something that's been widely talked about this whole year. There's probably supposed to be 6 cuts this year, most likely going to be 3 cuts this year. We'll see how that goes. I personally believe it's going to be a slow reduction of rates, but that's only one side of the coin when it comes to policy and the economy. The other side is fiscal policy. It's adding tariffs to corporations, whether it's domestic or international. The corporate tax cut, which I believe doesn't even exist. Like, sure, it's there, but you and I are paying for it. We're paying for it at the grocery store, at the gas market, on Google, on Amazon, on everything we're paying for it, one way or another. And we've seen that. I've seen that. And another form of it is minimum wage. You go to a McDonald's now with $20 an hour minimum wage. Well, they're cutting hours. Service is poor. The cost of a number one is like $15. Like, my God. I'm not even that old, and I remember when it was $2.99. Like, seriously, that's a Big Mac for those who don't know. And the idea with all this is everything is getting more and more expensive. And who's the loser? We're the loser. We're the ones that are paying more. Now, some can afford it and some can't. That's not cool. And they're the ones who don't have a hedge with their money invested. That's why we recommend starting as fast as you can investing your money. Because guess what? If you're going to raise taxes or impose tariffs or make it harder to operate through sanctions of higher minimum wage and so on, of forcing people to spend more money and pay more, they're just going to up their prices. We just saw it with Mickey D's. The $11 Big Mac meal is now almost $15. They don't care. They have to make their 30% margin. No questions asked. I see it all far too often. I do this every day. I don't expect you to do it, but as I'm talking, you're like, yeah, you're right. I remember my wife and I, we bought these like outside Edison lights we put in our backyard, right? So we can go outside and have lights outside. It looks really cool. It was awesome. For 50 feet was $39.99. Those same Edison lights are still $39.99, but they're not 50 feet. They're 25 feet. Half the cost for the same price. Some people call that shrinkflation. That is forced based on government changes and implementations that they're doing that make it that makes it more expensive to do business in certain areas. These are the things that people don't think about. They don't care about. Quite frankly, I don't blame you. Actually, the more ignorant you are, the more happy you should be. And I hope that's for everybody. But the one thing that I've seen of successful rich people, wealthy people, people that quite frankly always seem to win in whatever they do. You ever see those people, everything they touch turns to gold? They understand the concepts of delegation and just focusing on what they like to do and what they're good at. Not everybody's good in their legal work. That's why they hire attorneys. Not everybody's good at taxes. That's why they hire an accountant or tax planner. Not everybody's good at investments. They're good at making money, but they're not good at growing money. This is why they hire a financial professional. And this is why we're offering 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost. We want to help you. We want to help relate this show to your specific situation. Give us a call, 1 to 2 meetings, 1 to 2 hours, no cost, doesn't matter where you're located. Phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short. We can answer those questions that you have. We can take a look at what you're doing. We can make sure you're keeping up with inflation, keeping up and making sure your portfolio is in a situation where if the interest rates were to go up again, or quite frankly going to come down, which is what we're seeing right now, or what we will be seeing, I should say, because it's not a matter if it's happening in September or October or November or whenever. We know it's going to come down. Because right now we are seeing the impact it's having on the current economy. The rich are only getting richer, and those without money are struggling. We're seeing that with the low savings rates and the high credit card rates.
That was a fast show, folks. I want to thank you for tuning in with us this weekend. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go and visit our Knowledge Center, which redirects you to YouTube. We have over 1 million views, folks. And if you want us to discuss anything on YouTube, on the show, whatever, send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And if you want this episode, any one of our previous episodes, you can go on podcast, Spotify. We have them all there. And folks, we want to thank you for your trust. We want you to feel free and feel comfortable to reach out with any questions that you have. Have a great week, and God bless.